If you don't mind, I'm going to start. My name is Stuart McAlpine from Clyde, London. Apologies for being unable to introduce myself in the splendid Greek that Stephen Drury used, but so forgive the English. I'd like to introduce my panel on new and alternative sources of finance for ship owners, which I think is an interesting topic as we head into 2018 and probably beyond. So I have here on my left Iraklis Tsirigotis, Head of Shipping Amsterdam Trade Bank, then Omer Donnerstein, Senior Vice President of EnTrustPermal, Markus Wenker, Head of Ship Finance Hellenic Bank, Roos, Managing Director of Maritime Asset Partners, and last but not least, Mr. Axel Siepmann, Managing Director of BRAEMAR NAVES Corporate Finance. So you will see that we have two banks here, quite new banks to the industry, who will talk a little bit about the way they see things and their approach to business at this point in time. We have two non-bank institutions represented by Nick and Omer. And then, again, last but not least, we have a corporate finance advisory boutique represented by Axel. So I'm hoping that we'll get a broad range of perspectives. The bank panel I thought was very good, very interesting. The bottom line is, though, that the traditional banks who finance this industry over the course of the last 20, 30, 40 years have pulled back big time. These banks here, I know, are all, who were here, are all active to some degree, actually. But the fact is that the industry has seen capital disappearing from its traditional providers. And the question is, how is that going to be addressed? And I think some of the guys on this panel hopefully can help us answer that question. So I'd like to start, actually. I'd like to move away from the banks, and I'd like to start with the non-bank institutions here. And Nick, why don't you kick us off and tell us something about how you see the opportunities for your organization and how you see the alternative finance world at this juncture.
Hi. Yeah. So though the universe for ourselves as non-bank lenders in this market really is there to fill some of the funding gap. We've talked about this funding gap now for coming up for 8-9 years. It remains very real. We've heard from the bank panelists a moment ago about the regulatory pressures and the effects that that's having on their risk appetite in the market. Even though we are seeing a number of those traditional players slowly but surely coming back with liquidity into the market, they are coming in at lower attachment points, lower LTVs. They're more risk averse. And the volumes of transactions that they're looking at in terms of single counterparty limits is certainly lower than it was in the previous cycle. Equity, on the other hand, of course, is in very precious supply right now. Those owners who've weathered the last 8-9 years have invested very strongly in supporting their businesses, and perhaps there isn't the amount of dry powder that there has been in previous cycles. And we're there to sit as what's been described as alternative or complementary, well, I don't really care what it is. We're there to sit is that intermediate layer of capital, sitting above the senior lenders, but with operator, owner, sponsor, equity ahead of us. So in that respect, I see our role there as leveraging equity into this new cycle, so that we can help to develop those markets.
Thank you, Nick. And I think that what's interesting about what you said is the fact that you see yourselves cooperating with the banks, and I think everybody recognizes that the bank finance has been critically important for the industry and will remain so. I'd like to just, before I come to Omer, just maybe ask you, Iraklis, and then also Markus, just to say a few words from your institution's perspective, your relative newcomers to the industry. So how do you see it, and where do you see the opportunities and indeed the need today?
Indeed, Stuart, we are fairly new players in the market. We started about 1.5 years ago. Basically, we saw a great opportunity for us to step in as a new organization. Of course, the bank has existed for more than 20 years already. But basically, we saw a window there basically to become very relevant to very nice, basically partners of us. The need for capital is across all the segments in the shipping industry. As you mentioned, the previous speakers already expressed, their view on how things are progressing. The need, I think, is going to only get deeper and bigger, actually. Yes, we are a newcomer to shipping finance, but basically we remain, a small bank, and basically we try to become and be as much relevant as we can for our partners. One of the things that, of course, we try to do is basically employ every single penny that we have in our disposal very carefully, and do it basically with partners that we feel, very comfortable, and we share the same view and the same opinion on projects. Now, of course, the view for this year is our view at least, is to do more business in this market, and as I said, expand our presence also in Greece, but not only, international as well.
Great. Can you say something about deal parameters, something about the type of owner that you're looking to finance, and something to give the audience here a sort of a sense of what you're mainly looking to offer?
Absolutely. There are two things which are very critical to us. The first one, which is something that's not going to be really new to the people that are here in this room, is where we are on the cycle, because we try to take a very much counter-cyclical approach, as we hope and believe that most of our partners would like to do. So therefore, that's number one for us. To give you an example in that respect, we expanded the dry bulk exposure significantly last year. We did that selectively and strategically, and it wasn't easy. I have to say that I still remember when we approached our credit committee showing cash flows that were at OPEX, if not below OPEX, and still had to convince them on why on earth we should do that. Mm-hmm. But we were there, we did that. Our portfolio is significantly exposed to dry, and we feel very comfortable. And also another point, maybe it's a good bridge to my fellow speakers, is also the cost of capital that came along with that. And the cost of capital but basically we were there to support new acquisition, new investments at what we think it was the right point in the time. And the second parameter, which is key next to where we are along the cycle, is of course the partners that are next to us, basically. The track record, the experience they have, of course how overall their investments have been done along the cycles as well, because we need to share basically the same view. These are, I guess, for ATB at least, the fundamental parameters of doing that.
Terrific. Terrific. No, thank you very much. And Markus, can I bring you in now? Hellenic Bank, based in Cyprus, started for business, I think, in shipping finance anyway, about 1.5 years ago, something like that. Yeah. So give us your perspective on things today.
Yeah, I think to mirror what colleague from ATB said, we are a new bank in this business of ship lending. We are not new to the shipping per se. We have been active there in transaction banking for many years. But yeah, this is a new product to the bank. And today's a heavily regulated banking environment. It's not an easy task to set up a ship finance desk, because shipping is not the flavor of the decade, probably, for the regulators. And this is, we had it on the previous panel discussion, this is a problem for ship owners ultimately, because to large part the financing that's available from the international banks is not fit for purpose anymore, it's fit for regulation. So for instance, when you look at the corporate structures that are required nowadays, the strong balance sheet, in the end just a combination of various projects, because in the end most of ship finance or shipping activities are project activities and project finance. So we are trying to break that by finding our target audience in the smaller to medium size, to not necessarily have those big balance sheets and corporate structures in place, and try to find other sorts of comfort. Yeah. Excellent. Okay, that's helpful. Thank you. Omer, I'd like to come to you now, if I may, a non-bank panel participant. And you're at EnTrustPermal, based in New York City, working with my old friend, Mr. Eng.
It'd be interesting, I think, for me and for hopefully others here to hear a little bit about your organization and what you're looking to do and where you see things going.
Sure. So we, first of all, thanks everyone. We launched the Blue Ocean Fund, as we call it, as a direct lending platform. 100% focus on the shipping industry. Really, as Nick mentioned, to provide financing to companies that are not able to tap the bank financing because of regulation, because banks have been pulling out of the space. We have very broad investment mandates, so we know we can do, and we have been doing anything from senior secured loans to all the way up to structured equity or preferred equity, and everything in between. We have one self-imposed limitation, is that we don't want to have, we don't want to be in the common equity. We leave this to the people here in the room, the ship owners, and happy to talk about why we don't want to do that. We're indeed a new platform, but we're not new to shipping. We have more than 60 years of combined shipping history within the team, and I think we're probably the only shipping team sitting in a large fund out there that really has the benefit of all the infrastructure that a 20 billion asset manager has to offer. I think the deals that we've done so far, and just to date we've deployed over 250 million in multiple transactions. All of those deals were deals that banks could not conclude for multiple reasons. Either the timing, there was a timing crunch, and the deal had to be finalized in a short period of time. The structure didn't work, maybe the leverage was too high for the banks, and also regulation. Banks are not able to lend, most banks are not able to lend in a counter-cyclical manner. And for us, obviously that's the right way to do that, because in that way we have less downside risk.
Iraklis mentioned about the dry bulk sector. Any particular focus for you in terms of sectors in the industry? Omer?
Sure. No, so we're completely agnostic. We always say there is no good or bad sector, there are good or bad deals, and we follow this principle. In terms of companies, I think this is the first time that we're sitting here since we launched the fund a year and a half ago, that we're sitting here in a panel, and I think that shows something how of the importance that the Greek market is to us. I think when we started, we felt that many of our clients are going to be small, and that hasn't been the case. We've worked with both small and large companies that are willing to think outside of the box and are looking to be more creative, and when they think about the capital needs. And I think it's needless to say that for us, we're looking at quality management, quality ship owners, management teams that are experienced and have been able to navigate through multiple cycles. That's extremely important for us.
Okay, thank you. Axel, you've been very patient. Thank you for that. I'm going to come to you now, a founding partner of NAVES Corporate Finance and now a managing director at BRAEMAR, NAVES Corporate Finance. So we've been talking during the last few minutes about how the finance world is changing in shipping, and maybe you could just give us your perspective on that and tell us how you see things and how BRAEMAR NAVES sees things at this time.
I think what clearly everybody in this room has experienced is that financing got a lot more complicated, and the market is by far more intransparent than it was, with more players, and and very different financing parameters. So for me, the biggest conclusion is, if as a ship owner you want to go for financing, you need to come to a fair judgment on, what do you represent, what do you look like, and then basically get very focused to those sources of financing that fit to your case. Arguably, there's still traditional lenders around, but I would say they focus on certain core clients. There's at least the tendency to that. But there's also banks that are still willing to finance medium-sized companies. So at the end of the day, I would say there's much more risk-adjusted pricing to be observed. And as to get the best possible financing, you need to tap into the right sources with also the right structure, documentation, be much better prepared. So I'm still optimistic. There's one good news to be spread is that if you look to other industries, corporate lending for traditional banks at the moment is an extremely low margin business. And the shipping industry at the moment offers attractive margins. So I'm completely opposing the fact that, financing is drying up for ship financing. It's just much more difficult to get it.
That's helpful. In terms of, and I'd like to stay with you for the moment if I can, but in terms of the future, if you could project forward to the next 5-10 years or so, do you see in this, this panel sort of fits in between bank finance and private equity as alternative sources of financing in shipping. Do you see a lot more entrants coming into this particular space? Maybe doing what Nick was saying earlier on of lending into a particular piece of the capital structure behind the senior lenders, but above the equity. Do you see that trend as one that's going to develop and grow as we move forward? And I'd like to stay with you, Axel, and maybe come to a few others on that question too.
Well, I've just spent more than 10 days traveling through Asia, talking to more than 15 leasing companies and financial institutions. I find there's a very interesting development going on because whereas I would say historically leasing companies were known to focus on new building financing, finance leases, there's more leasing companies now looking at operating leasing structures, more looking at secondary financings, and there's also institutions in Asia that obviously need to spend the excess dollars that they have and are considering to make shipping loans. So that, I would say, is a relatively new development, and we all need to carefully observe whether that trend will strengthen. It could definitely be a big new opportunity to close a funding gap that obviously at the moment exists between, I would say, traditional European bank financing at still modest margins and the alternative capital sources that sometimes are quite pricey, but look, at the end of the day, risk-adjusted pricing. So I would say in the middle, at the moment, there is a gap that most, medium-sized owners, especially I think, for Greece, quite relevant family-owned businesses, that needs to be targeted. And but I'm optimistic. Markets have the tendencies of being quite efficient and adjusting. So I would say if 60% loan-to-value financing is judged by this audience as conservative, and it's very hard to get that financing at what probably most people in this room would regard as a reasonable margin. Let's be optimistic that some people that work in the business of providing financing think alike and work hard to close that financing gap.
Thanks. And actually, one last question, because you reminded me about your trip to China, which you'd mentioned. There were some reports towards the end of last year that the leasing houses in the PRC were coming under increasing pressure not to lend against new building contracts outside of China. Was that something that was that you perceived as an issue during your discussions, to the extent that you can share that with us?
Well, let me put it this way. Of course, it's much easier to get Chinese lease financing from a state-owned leasing company if you place a new building order in China. I mean, most people here will know that there is certain leasing companies that are actually working closely with particular yards, are owned by these yards groups. So I would say, but it appears to me that there is still room, to discuss also there's private leasing companies that definitely at the moment have also a wider flexibility.
Okay, that's helpful. I started off by posing the question: is the alternative source of financing? Is this the meat in the sandwich between the banks and the private equity? Nick, I'd like to come back to you and sort of ask you to address that and to maybe talk a little bit about the ambitions that you have for your relatively new business over the course of the next 5 years, and how you see that developing, and where you see that developing in terms of any particular sectors, any particular geographical areas of focus, that kind of thing.
Sure. And of course, yeah, it is the meat in the sandwich. For me, it's the interesting bit. The gap that we've been talking about, and as Omer says, I think that the secret to making this tier of capital work is flexibility and to be constructive in discussing individual projects. Unlike the bank panel before us, we're overwhelmingly here, I think, more asset-focused and project-focused than corporate lending. But as the capital that we deploy gets more like structured equity, if we look at the potential for holdco loans at corporate financings, or whether it be prefs or structured equity of any sort of description, then our mindset and the background of my team and our investors, the long history in shipping makes a big difference when you come to those kind of transactions. And at the other end, if we're looking at a more straightforward first mortgage loan, a unitranche loan to a small mid-cap owner with a small number of vessels who's not being served by the banks, that's traditional lending. It's traditional loan finance with a mortgage on documentation that everybody in this room will be very familiar with. The way that we will survive and the way that we'll develop our business and grow our business through this cycle is to be responsive and to be flexible at all times, keeping our eyes very, very close on the credit fundamentals that we're trying to build the business on.
Thank you, Nick. Markus, can you talk just for a minute or two about your, where your sort of sweet deals are, just so that people here get a sense of what type of business Hellenic Bank is looking to do.
Yeah, we don't need a corporate structure in place, which is first thing. We focus basically on those ship owners who don't catch the attention of the international banks anymore. Small to medium-sized ship owners that want to finance single vessel transactions where, because of the crisis, obviously the transaction values have also dropped. We don't have minimum ticket sizes like many other banks do have. We can do a transaction below 10 million, we can do a transaction below 20 million, and we don't require the corporate structure. So our sweet spot, I would say, is in the region of 5 to 25 million. We look at transactions primarily in Cyprus and Greece, in segments of dry bulk and tankers. Within those segments, we have some sizes we prefer and some sizes we don't like that much, because we also put a lot of emphasis on understanding the markets, and we understand that the trading patterns in shipping are constantly changing, and that even the best owners will lose in a market that's declining, where the demand for vessels, or for this particular vessel size, is not there anymore. We have seen it in container shipping with Panamax container vessels, where 7-year-old vessels were sold for scrap. So we put a lot of emphasis not only on the counterparty we work with, that the counterparty has a proven track record, but also the asset itself, that the asset has a demand in the market.
Thank you, Markus. Omer, I just wanted to come to you, and you talked a little bit about not being focused on any particular segment of the industry, and you talked a little bit about the sort of broad range of credit transactions that you do. One thing that I wanted to ask was, to what extent do you see your competitors really in the New York market looking at shipping with a keener eye than maybe they've done in the past? Is that something that's happening, or do you think that your organization is a bit of an outlier, and looking at this opportunity in a different way?
Sure. So I think, as I mentioned, we have a very broad investment mandate. And some of the deals that we've done, if you go back 2-3 years ago, you would have been discussing them on the bank panel. And then again, the next panel is private equity, and a lot of the deals that we've done would fit, those type of organizations. So I think it's very difficult to say, hey, what exactly is private equity doing? What is alternative finance doing? And so forth. I think what we're ultimately doing is really being the banks, if that makes sense. I mean, we're doing business that banks, used to be able to do in the past, and are no longer able to do that because of regulations, because they decided that some European banks decided they don't want to be in shipping anymore. And I think just like our competitors in New York, the hedge funds, some of the private equity, I mean, at the end of the day, we're in the business of providing our investors the most attractive risk-adjusted return, and we feel that shipping now, given this twin dislocation I mentioned, the fact that where we are in the cycle is a very interesting place to deploy capital to.
That's great. Thank you. Thank you very much indeed. I just want to sort of change tack slightly and talk a little bit about the world of new buildings. And a couple of us on this panel did a similar panel actually in London a couple of weeks ago, and new buildings came up, and there were some quite strong views expressed. So maybe Iraklis, I could start with you, and maybe you could talk a little bit about Amsterdam's trade bank's appetite in the new building sector, whether it exists now or.
Well, we already have some exposure.
Right.
To one case actually, which is very limited exposure. Are we open to look into new buildings? I would say in principle yes, but the buts are quite a few, a number, because we need to justify ourselves why to do that. And as I said, where we're in the cycle is number one, but also other things about whether there will be some employment on day one, and what's the construction price, and the likes of that world. But basically, we have looked into, as I said, into new buildings, so we are not afraid of new buildings. But we like also to take a very cautious approach about, does the market need new buildings? Let's start with that. Let's start with a fundamental question. I don't think that any segment right now needs more new vessels, including dry bulk, because yes, the market has picked up, but it has picked up from a very, very low point in the cycle. So it's not like the case that we are back in 2007 or 2008, whereby our partners are making piles of gas. We're not there yet, so I don't think we need any new buildings. But if you ask me about what are our sweet spot, I will say any range between 5 and 10 years old vessels. This is where we feel very comfortable to take some exposure in.
Any other comments on new building finance? I'd like just to throw it out there to the panel.
I think I would make 2 points there. I think there's one economic side to it. In the current markets, the economies for a second-hand vessel are simply better than for a new building. The risk-reward, both in my belief for owners, but also for banks, is much better. And a second aspect, and this was quickly mentioned before, I think the world has seen more than enough new buildings. I think the crisis started because of new buildings, fueled by banks. Then after the crisis started, financial investors came in, so we had new building orders fueled by institutional money. So this extended the crisis, and we shouldn't fall into the same trap by now going back to the shipyards and both banks and financial investors financing those new buildings. I think what this market needs is to go back to its roots of being an industrial business of transporting goods from A to B, not being a place for speculation, and especially not speculative orders. I think this market needs to have a cooling off period for some time to rebalance supply and demand. I think one other aspect is that we have seen it in the tanker markets in the last years, where I remember back in 2012, the order books were down to 4 or 5%, which one could even say is low. So companies came fueled by institutional money, and out of the sudden the order books jumped to 15-20% again. This delayed the market recovery, and I'm a bit afraid that we see the same in dry bulk now, because we see shipowners going to China, placing orders, and that in combination with the fact that there's a move of ship finance from the west to the east. We were hearing about Chinese leasing houses, we were hearing about Chinese banks, and those guys have a different motivation. They need to keep their shipyards employed, and this is one of the biggest risks. Also risk there in my mind is why we all should keep away from new building orders is the regulatory aspects. We have changes in environmental regulation. I think, at least I don't know how in the end it will exactly look like. I think there were a few bankruptcies of ballast water management system manufacturers because in the end what they promised to provide was not what they provided. There's uncertainty around a sulfur emission, whether there will be scrubbers, whether there won't be the need for scrubbers, whether there will be sufficient low sulfur fuel available or not. So all those risks add to it that I think it makes it very unattractive, both for financial investors but also banks, and I'm representing a bank, to provide new building finance today.
But at the end of the day, you know, the market will decide. There's nobody on this panel or even in this room is going to control what remains a very, very fragmented market. It's very fragmented on both the demand side and the supply side. Individual equity investors will make their own judgment as to whether or not they think that the time is right to go back to the shipyards. The shipyards will make their own decisions around what the price is. And you know, if it makes sense for us on a project-by-project basis, then we'll look at those deals. But it will be done on a project basis and not through any great sort of philosophical idea as to whether it's on the whole a good or a bad idea. I do agree with you that on the whole we tend to see better value in the older vessels. For us, that's largely because the greatest amount of liquidity that remains in the market is against those new builds. So there's a greater need for our capital in those older vessels. We will look at those older vessels. We will look at depreciated values out to 20 years plus around what we still believe to be the economic life of those assets. We're not driven by policies that tell us that we've got to be fully out of these deals by the age of 12 or 13 or 15 or 18. But at the end of the day, the new build market's not going to go away, and the fragmentation isn't going to disappear anytime soon either.
Helpful, thank you, Nick. Axel, I'd like you.
Yeah, I would say, I hate, these digital discussions, new buildings, yes or no. I think as a matter of fact, we will always see a certain degree of new building activity. One potential driver of new building activity, to my mind, will be the tightening environmental regulation. That certain clients, that have cargo, will also firmly require these ships. There's certain parties that reputational-wise just want to have top modern green ships, and they're prepared to pay for that, and then these ships will get ordered and built. So I think you need to be out there and screen the market and see what is the need. And in certain years there will be more new building activity. In certain years there will be less. But let's not forget. I mean. Yes, we had extremely packed order books acquired a few years ago, but it's getting lower at the moment. The global economy is still expanding. So I would say, if as a ship owner you make a strategy today and you look 3 years ahead and you're not too pessimistic about the outlook in the world economy, it's also wise to look at new buildings and how you would get these new buildings financed.
Thank you, Axel.
Sure, I feel that I need to chime in.
I
give my view. So
I was coming to you.
I think that personally, I don't think it's my place to sit here and tell, irrespective of what the view on what more new building will do to the industry. It's not my place to sit here and tell you what to do. I mean, you're going to build ships if you think it makes sense. From a return perspective, a year and a half ago, the typical 5-year-old dry bulk was trading at 50% discount to new building price, and nobody went and ordered new vessels. But again, this is not, it's a decision that the people in this room need to make, not the people here on this panel. And I'm going to quote Robert Bugbee, 3 years ago, was sitting in a panel, Capital Link panel in New York, and I think what he said is that shipping is not a team sport. And each one of you need to make the right decision for their own business.
Yes. Well, on that note, we're heading into the last few minutes, actually. I think I'll throw it open for questions now. So if anybody has any questions for any of the panelists, now is the time to raise them. I think it's been, a very interesting cross-section of views from different, different institutions, different organizations, stepping into the market at this very challenging time for capital raising and for ship finance generally. So if anybody has a question or a comment, please feel free. A flippant one. He's obviously a rugby man.
I'm not sure how to answer that.
Good. Thank you very much indeed, ladies. Sorry, there is one. I'm sorry, just one. Gentleman. Please, after you heard the question.
Since I'm sitting next to you. First of all, I think needs to be made a differentiation because there are two banks across the panel, which of course have a different approach to financing. If I can comment only about the business that I represent here, there is not a magic number about how much we need to basically to price every single deal. Each deal has its own merits, and we take that view and we actually try to be competitive and price it fairly, because I think that's the key word: price fair. Representation of the risk that we are taking. Now, let me give an example to make things a bit easier. And I'll go back to what we did last year in ATB of financing some dry bulks. Yes, the numbers that we presented to some of the existing groups that had track records for many decades seemed on the high end. And of course, there were questions about that. But since then, and while we position ourselves at that particular point in time, at the most difficult point in time, and if I compare when we entered into now, the values of the investment that we have done have actually doubled. So whatever is one might be perceived as extra margin, the 2%, the 3%, whatever is the number, the magic number, everything is relative. Because if we indeed support our clients at the moment where they need the greatest support, and we have done it in a very concrete manner, then the 2% is negligible. It's peanuts in the bigger scheme of things. And that's just an example to make a point of, basically our approach to shipping would like just to become very relevant.
Thank you, Iraklis. Does anybody else want to respond?
I mean, I could take that. I think that obviously there is a spread between what banks on the previous panel, how they price their deals, and between some of the other banks here. But I think that there's additional value that some of the non-banks provide here, and I mentioned if it's a time crunch, if it's more leverage, and or a sector that they're not able to leverage to just given regulation. I mean, I can tell you that we had one of the deals that we've done. We had a ship owner that came to us 6 months ago, was very bullish on Capes, and wanted to lever up to the cycle, and from where he stood, it was either I'm going to buy 1 or 2 vessels, all equity, or I'm going to buy 5 or 6 vessels with leverage. And so we provide a way to leverage that conviction. And if you believe in that conviction, and if you believe the market is going to increase, then whatever, irrespective of our cost, I mean, the deal will be good. And I'll just conclude by saying that for us, we spend a lot of time structuring and thinking about the structure we put in place. And the bottom line is that a deal works if both sides make money.
Here.
I think that's exactly right. I mean, look, there is no single price. Our pricing is risk adjusted. I believe it's rational, and it sits somewhere between what first mortgage lenders will do for 50% LTV and what equity will do for 100. And we're somewhere in the middle. If we're less expensive than the equity, then there's a very interesting conversation to be had.
Okay, well, look, on that note, I think we are now out of time, so I'd like to thank each of you very much indeed for your contributions. Thanks very much indeed for your patience, and enjoy the rest of the afternoon. Thank you.
I think that's always a bit silly.